The US Sunbelt, from an economic demographic perspective, is set up really well to keep growing for the next decade and more. Whoever is able to raise capital or maybe even have a balance sheet right now to be active, I think there's some really good deals to be made.
If you're able to raise capital and have that money when others don't, that's really where you find these generational opportunities.
We do think that Miami is probably going to be the market where we have the largest volume of investments and developments.
South Florida, you've got the Everglades to the west and the ocean to the east. It's landlocked.
People, I mean, I've heard, and I think that the first time when I moved here was like the Hong Kong of the Caribbean, and it's a very good way to put it, right?
My name is Omar Morales. I'm a commercial real estate broker that's closed over $3 billion worth of deals in South Florida. This gives me access to some of the most prolific real estate deal makers in not only South Florida, but also the country. My goal with the Real Estate Deal Makers podcast is to keep the conversations timely and current so you have a better understanding of where the market is today, and more importantly, where the leaders of this industry think it might be tomorrow. So let's dive into today's conversation. My conversation today is with Rafael Aregger. He is the US Head of Investments for Empira Group, which is a leading player in the alternative investment space across Europe and the US with over $8 billion of assets under management. They invest across the real estate spectrum, from developments to debt, infrastructure, and everything in between. Locally in Miami, we know them as a Swiss and German developer that is currently building 2 luxury multifamily projects between Brickell and Coconut Grove that I'm really excited about. Today, we discuss how, despite a global reach, why Rafael and the firm are particularly bullish about Miami and the US Sunbelt. We talk about how some of their European pension fund capital views allocating to the US, some of which refer to Miami as the Hong Kong of the Caribbean. And we discuss how Empira Group is approaching the market differently down here. It was an absolute pleasure to be one of the first guests at Empira's new US headquarters in Miami. They are in the top floor of the largest office building in the state of Florida, which I think is a testament to the type of money that's continuing to come down here. Here's my conversation with Rafael.
Rafael, thank you for taking the time and also hosting us in your brand new Miami headquarters.
Thanks a lot for coming here. Very, very happy to do this with you.
Absolutely. So I think where we should get started is talking about Empira and sort of the roots of the company, where you guys are from and how it got to be, what it is today.
Absolutely, yeah. And also Empira has a very interesting story, a very international story. So like the company's headquarters in Switzerland. Actually, company got started, founded in Switzerland in the early 2010s, actually, by a founder by the name of Lassenknapp. He's German. He's highly successful in Germany previously to founding Empira. Did a lot of investments in the equity and in the debt space and really made a name for himself. And then basically took that track record, came to Switzerland, started that company Empira with the goal of essentially pursuing similar types of investments that he did previously, which is really, again, both on the equity and the debt side in Germany. And if you kind of want to summarize Empira's businesses previously or prior to going really international, we essentially raised capital from the German institutionals. That's really German pension funds, German insurance companies. And we invested on the equity side mostly in ground-up developments. And ground-up developments is usually, or mainly residential developments and a bit of office developments actually in there as well. Usually in very urban areas across the kind of the largest 7 German largest cities. And on the debt side, we kind of cover the entire capital stack as well. Work with all the developers. We do senior loans, whole loans, more junior tranches, actually structured JV equity as well. So in a lot of ways, we actually act as an advisor of some partner developers and are able to kind of give them advice and structure the entire capital stack for them. And so business has grown really nicely, and we have about 8 billion in assets under management today. It's about 4.5 billion on the equity side and about 3.5 on the debt side. And it has really allowed kind of the company to build, I would say, a very nice operational platform. Bit of a, I mean, at least kind of when it comes to Europe, a bit of a machine with kind of a fund management team sitting in Luxembourg. We have about 30 people there. They do everything from like fund administration to portfolio management to compliance, kind of really everything that you need to kind of manage your own funds. We do that in-house, which I think is a very nice competitive advantage versus competitors.
Yeah.
And then we really have, I would say, a very technical team spread across Germany. that are a lot of engineers and architects and really kind of technically skilled people that are good at development. And so that has shown in the track record. I think the team has been very successful, and it allowed us to build really good relationship with equity investors in Germany. And so a few years ago, we basically, I think the company started to think about what are the next levels of growth for us, which is really going international, right? And so for us, the US was an obvious target market. And so we knew from the investment side that we wanted to take the business into the US and really...
When was this? Was this 2 years ago, 7 years ago?
I would say the initial thoughts were probably 4 or 5 years ago when the company started thinking about it. And then obviously it was a lot of first conversations with potential investors. Like, what does it need to... would you trust us? Like, would you follow us? Do you support us? And then obviously like thinking about how to execute all this, right? And so I think the way we started it actually is in early 2021, we started a JV with a partner based out of Indianapolis, where we started buying on a 50-50 co-GP basis value-add properties across the Midwest.
Multifamily or anything?
Multifamily and like 80s, 90s vintages. So a bit of actually like stabilized, good, well-performing assets, but with a bit of a capital improvement program. And at that point was a good entry point in the market where we were able to acquire a few assets at pretty good prices, right? And so
2018, 2019 was the heydays of buying value add, especially into what happened post 2020.
That's exactly right. So like that, the entry point of that, essentially the initial portfolio was perfect. We kind of kept it going throughout 21, and then I think when we came into 2022, we put a bit of a pause on acquisitions in the Midwest just because prices kind of really ramped up, right? And it was maybe a little bit less attractive for a moment, but we own 9 properties up there, and it was a really good entry kind of start with a very capable operator on the ground to kind of enter the US.
Good risk-adjusted return, like you know what you're getting yourself into with a known GP.
Exactly.
Because development, it's a whole different undertaking.
100%. And you need your own. I feel like development, you really need like your own staff, right? And what always was clear for us that we can't do like an owner's rep approach where we like do development for far away and then trust somebody else to manage it. That's not really the way it worked. But at the same time, so for us, it was always clear, like we want our own people on the ground to be able to be on control of that, because the entire thesis was essentially, brings us back to a bit of the German investor profile. When you look into their real estate allocation, a lot of them, they have huge real estate portfolios, where you would say that these huge real estate portfolios, they actually need a global allocation. And when you think about global allocation, the US would need to play a pretty big role and part in that, but they're like woefully under-allocated to the US. And there's different reasons why that's the case. I feel like real estate investors, they always have a bit of a domestic bias, but I think for German or European institutional specifically, some of the issues are also structural because of market inefficiency. So for a German institutional to invest in a development project here, say in Miami, you have so many intermediaries between you and the property. I mean, you probably have a developer, then you have a GP on top, then you may even have another GP who kind of bundles as an asset manager of sorts. So maybe in between you and the property, you may have 2-3 different fee layers and promote structures. You have like the entire reporting is all over the place. And then there's like individual topics, like for example, sustainability, right? Which is very important for a lot of European institutionals that are, if you don't have direct touch points to the developer, it's just very difficult to execute those type of initiatives, right? And so I think some of these inefficiencies due to kind of the market setup have led to a lot of firms just not undertaking any sort of developments or more complex type of investments other than just buying stabilized properties, right? And so our value proposition was essentially, look, you guys have done this with us in Europe. You know how we work. You know how we report. You know our kind of priorities. Trust us, like to do the same thing with our own people over here. And it worked. A lot of people came and followed us.
That's amazing. And you guys raise like a fund, or is it deal by deal? Hey, we've got this deal. Do you want to support this deal? Or you go and raise hundreds of millions of dollars? No,
we were actually fortunate to really start out with a fund structure right away. So we basically put a thesis together where we said, look, we're going to focus on the US Sunbelt. That was 2021, so mid to late 2021, where we went into the market with that. Can put a thesis together to say, like, look, the US Sunbelt from an economic demographic perspective is set up really well to keep growing for the next decade and more. So we're going to put a long-term fund in place, like a very traditional private equity fund structure with an initial 10-year term. And we're essentially going to execute a develop to hold investment strategy to where we buy sites, get them permitted, get good plans in place for the right type of development concept, and then execute and then actually hold the assets. And again, like we're very fortunate to be able to capitalize that fund quickly, actually, with some of our legacy investors, which then really allowed us also to go into the market and buy what I think are really good sites here in Miami and then one site in Dallas, and to really get that ball rolling, right? And so,
yeah, I'll never forget. So you guys, when you came to Miami, and I saw, I think, like a press release or something about Empira, Swiss-German fund coming to develop down here, you hosted a big event at Faena, which I was like, oh, cool, you know, Faena. And when you go and you like rented out this entire venue space, it was you know, a lot of money, very well done. And we met the chairman, met all your partners and colleagues, and then also a lot of industry professionals that are in Miami were all there. And what was interesting is, as a broker, I get so many calls of people saying, we want to break into Miami. We want to be. And I'm like, sure, you hear how great it's been in Miami and how it looks to continue to go. And out of 100 calls that I receive of people that want to break into Miami, not that many people, you know, follow through and end up breaking into Miami. You guys hosted this big event. I can't remember. Maybe it was like October or something like that of like 2 years ago. And by like February, I hear Empira closes on a site by Coconut Grove in Coral Way. And then now, a couple months later, you've closed on a site in Brickell, which is, you know, arguably one of the most, you know, land restricted, highest quality areas in South Florida. So quickly you're like, I'm buying here, I'm buying there. You're making a big push to it. I'm like, man, these guys we're not kidding. Yeah, look, it was a combination of things. I think, again, like the one part that kind of allowed this was to have a discretionary pool of capital to be really able to kind of build conviction and then move quickly. The other thing, and I do see that as a huge advantage, like from us as a firm, is we have one founder, essentially, so founder that is still 100% owner of the company. And I mean, he built a lot of conviction in going to the US. So like the moment he was like, go, let's do it, there was really no going back. You know, there was really only full speed ahead, and obviously doing it in a smart way and considerate, right? Like, again, I think we try to, our approach was like minimizing risk by really picking the right locations, the right sites. So really not taking any risks there. But it was basically, from a corporate perspective, the moment we said go, we really meant go. Like we didn't want to take 2-3 years to kind of tiptoe around. That's not it's not the Empira style. And I think it's good that that's not our style. That's amazing. So when you're talking to your German and Swiss investors and you're raising this capital, raising this fund, I don't know, maybe you can answer this question, but how do you think they compare the outlook and the viewpoints relative to like US domestic investors or pension funds and things like that? Are they looking for similar return requirements, similar investment horizons, or are you like, no, it's completely different?
Interesting question to answer. I mean, it really depends on the investor, right? Like what we realized is that, again, like kind of for a core market, German investors, it's a very diverse field of investors. Like you have like the insurance companies, which may look at completely different metrics than, for example, a German pension fund. So quickly drill into the German pension fund. Like these guys really have investment horizons of like 20, 30 years. Amazing. So they're looking at it maybe not as much in terms of like the immediate opportunity cost, but they're really trying to allocate their capital into very, very good locations that are like suitable for long-term hold, right? And so I think also when it comes to like the questions being asked, they're really interested in building a property under the right type of quality requirements, right? And because they know like, okay, if it's built the right way, the maintenance and operational cost over the next 20 years, like you will see that return on that, right? Whereas like if you were a merchant developer, let's say, I mean, I don't want to say the quality is completely secondary, but you're essentially, as soon as you're selling the property, it's somebody else's problem, what you're building here. And so it is a very different mindset. And so I think when we talk to different investors, the set of questions, depending on where they come from, like may be completely different, you know. But I think kind of most of our investors have a very long-term outlook. So we, right now, the fund is set up in a way that we don't have any 3-4 year exits. It's all like 10+ year holds. So they're really interested in getting the basis right. That's kind of the key criterion. Like, can we buy the right sites and get in at a reasonable cost basis? And then we can feel pretty good about ourselves like 10-15 years down the road. That's really the main philosophy.
Which is interesting because it's something I've noticed when I work with merchant builders, or for example on the existing value add or multifamily acquisition side, syndicators. You know, you think about real estate as an asset class, and it's basically like a wealth preservation tool that you want to hold long term to reap a lot of these benefits.
Exactly.
If you look at merchant builders and syndicators on the existing side, they like, let's lever it up. Let's try to get the highest promote as quickly as possible to flip in and out of this deal to get the biggest, like, you know, return and equity multiple. And like, you know, it's a great business model, make a ton of money, and investors do very well by great GPs that know what they're doing. But thematically, it's the opposite of why people allocate to real estate.
Yeah, I think you negate some of the key benefits of actually investing in real estate by investing this way. Fully agree with you.
It's so interesting. I have, you know, friends in the tech sphere that have done IPOs and, you know, have made millions of dollars. And they're like, if I want to, you know, 10x my money, I'm going to keep investing in tech. But if I'm going to give money to real estate, I want it to be low leverage, long-term hold. And it's, I think, hard to find GPs that have that investment outlook or criteria, right? Typically they want to, the incentives aren't as aligned as so I think that's really interesting. And you guys, is your investor base solely European, sort of Swiss German pension funds right now? And that's how you're looking to keep it?
Right now, yes. I mean, I would say a good, well, even like 99% plus of our capital is really German, Swiss capital. But there's a bit of development in place. I think, and that's, I would say, smart decision also probably by our chairman a few years ago, where he made a very conscious decision to kind of trying to diversify that capital base a bit. And so we opened, I guess it was about 2 years ago, we opened an office in London. We opened actually one in Stockholm as well. And then this year we opened Dubai. Wow. And so the whole intention behind that is really to grab footholds into these institutional markets, right? And to hopefully a few years down the road, like have a little more equal balance between where the institutional capital comes from. And I mean, the idea is pretty much, right, like if you could probably say, like, we wish we had done it even earlier, because let's say, like, what happened in the last 2 years, right? Like, you had a little bit of almost like windfall profits or cash flows in the Middle East.
Right.
If you were present there and you already had the relationships and then the track record, you could have really raised a lot of money there, right? And so, whereas maybe some other regions are at certain times a bit more difficult. And so I think by being globally present, like, we will just kind of be able to take some of the volatility when it comes to fundraising. And so that's kind of a multiple year process for us, because I think what we've seen is, in London is like the perfect example. It does take like a year or two to really build those relationships and get the story out until those first checks are written, hopefully by very credible investors. And then it kind of, things get clicking afterwards, right? And so London, like we see it right now. Now we have really good conversations, both for German and for US investments. But this took about 1.5 years for us to get this stage. And so we'll try to do the same thing in the US. So right now we actually just had a capital raising team essentially onboarded in August.
Oh, wow. Congratulations.
Yeah, it's exciting for us.
US domestic.
Yeah, exactly. So we basically have a director now operating out of New York. For the first part, he'll over time relocate to Miami, but still obviously spend a lot of time in New York. But the idea is to, over time, hopefully also build some US capital relationships and then to establish some, then probably really funds that are more targeted towards the US, right? Because we are conscious that the long-term hold, that works super well for European or specifically German institutionals. Probably if we want to really scale in the US, we're going to have to think about that a little bit, like and develop a product that is maybe more suitable for institutionals over here. And so we're going to be nimble about like how to execute this, but the general idea is to get this global diversification.
Yeah, I think it's a really good point that you mentioned where like there's capital flows geographically with like the macro environment. And by having a foothold in different cities, you're able to say, wow, there's a lot of people in the Middle East looking to invest and making money. Let's pull from that. Because the name of the game for me is like the cheaper the capital that you raise, the more active you're able to be and the longer
100%.
Time horizons you could have. Very interesting.
100%. And I feel like the next year or so is going to be a kind of a perfect illustration of what you just said, because whoever is able to raise capital or maybe even have a balance sheet right now to be active, I think there's some really good deals to be made, right? Like both in, I think development will have some interesting opportunities, especially maybe generational assets where usually you have so much competition and prices will be so high to actually acquire a site like this. And right now you may have situations where somebody has to sell and there's just not a lot of people around buying these type of sites. So it's a good opportunity for some groups to take advantage of that. And I feel like also on the existing asset side, right? Like there's a bit of dislocation. There's not a lot of liquidity. There's people that may need to sell due to different circumstances. So it's good deals to be made, for people that can raise capital. Yeah.
And from the broker's perspective, I can tell you, I mean, 18 months ago, I would have 27 offers on a deal.
Yeah.
All these offers were like, we're going non-refundable at contract, 15% over ask. Like it was, hard to be winning deals in that environment. And, people still did. Now we'll take out a deal. And interestingly, we're still getting like 10 to 15 offers, but they're way below ask. And when those offers, if we were to say, hey, this is your deal, they're kind of like, oh my God, can we close it? Right? Because they don't know if their investor base is still there if they're syndicators, right? And for me, if you can come in, we have one client in particular, he has like very strong balance sheet and he's being very aggressive right now putting in offers because he's able to say, I'll give you $5 million non-refundable for like, and giving a lot of certainty of closure, which a lot of groups can't give right now. So to your point, having that, if you're able to raise capital and have that money when others don't, that's really where you find these generational opportunities.
Absolutely. I feel like right now is the time for two types of investors. One, the family offices, like with a large balance sheet that they're not really bound by portfolio restrictions. They're ready to go, right? And I feel like right now where they maybe usually would get outcompeted by institutionals by just being faster, being able to bid more. Now it's their time to grab assets that they could usually never buy. And I feel like the second investor that right now is competitive is the long-term holder. Like if you're a little bit more patient, you have a longer outlook, it's kind of the same story, right? Like maybe the shorter hold investors, like they would sometimes be able to outcompete you just based on price. Whereas like right now, no, that's not really happening. So it's good times, I feel like, for these two type of investors.
Yeah, I think the dislocation that we're seeing given the interest rates will create opportunities for well-heeled investors. Because when the money is easy to find and invest and take, everyone's got money and it's basically you've got the marginal buyer, whoever is a little further out on the risk spectrum.
Exactly. What do you see on like seller side, like when you have conversations with them? Because I guess like especially related to land, right? Like unless you have like a very expensive land loan or something on your asset, you can really kind of say, I'm going to wait this out. Because again, like we're talking prime sites in Miami, I feel like there's enough people that have a very positive outlook on Miami to the point where you as a seller, you can just say like, look, even if prices are down maybe 5-10% right now, I'm just going to wait it out because a year or two from now, like we're probably going to be at an all-time high again. Is that kind of the way it plays out?
Yeah, so you're 100% right. I think with Miami or South Florida in general, what ends up happening is they're so bullish on it, even though the macro environment doesn't look great right now, that the sellers are like doing whatever they can to hold on to their properties. If I maybe had a piece of land in Wyoming or something, and I'm like, okay, I'm just going to dump this thing, it's over. But there's a lot of groups that, their pricing is down and they're just like, great, like I'm just going to sit on it for another 3, 5, 10 years. So we're being intentional about targeting and reaching out to groups that have land loans because they have a decision to make. And then we're also talking to merchant developers because they need to buy, build, and sell. And even today, with pricing being relatively depressed relative to what it was 18 months ago, the developers stabilizing deals right now, they're still in the money. Right. They're selling maybe, I'm just going to throw numbers out there. They're selling for $300 a door, but they built it for $220 a door, $240 a door. So they're still good. Right. They're not going to hit this home run and buy a private plane, but they're going to hit a nice single or a double and keep the machine growing. Right. And to your point, there's sites, especially in Brickell and downtown Miami, that have been owned generationally, and they're just not going to move in this market. So it's what we're seeing. I think to your point, there's going to be sponsor specific risk. People that over-levered, land loan, bridge debt. We sold a deal recently, and I'll be vague about it, not to speak of any specific sponsor, but it was exactly that. They bought a deal with like a 1-year line of credit, and they bought it early 2022. As soon as the market started doing this, 12 months later, interest rates were 5x what they were, and they had to sell, at the wrong time. So it's poor risk management, and I think Miami as a location is doing great and continuing to improve. But there's sponsor specific assets that I think will yield opportunities for people. And I'm actually curious for you because you're in Switzerland, Germany, and then you're coming over to the US. Here we are in Miami, which I'm very grateful for. So was that an easy decision? Were you guys looking at New York? Were you looking at other places? How did that come to be?
Yeah, it was actually an interesting process. I mean, we looked at whole range of different cities. I mean, New York was definitely in the conversation, right? And then some other Sunbelt cities like Dallas. Or I previously lived in Dallas, so that I knew that market quite well, and I know that it also has a pretty good talent pool. Austin was maybe a consideration, and then some of the other. I mean, for example, Phoenix is a market that we actually focus on from an investment perspective, but it was just too far away, and I feel like that's already what brings me why Miami in the end. I mean, the fact that it's on the East Coast and also kind of proximity to Europe and our ability to bring investors over and essentially be here in like a 7-8 hour flight. It's pretty huge, you know. It's a big benefit over. Yeah, you could say like Dallas is maybe not. It's still like 2-3 hours more, right? In additional distance. So the hurdle just goes that much higher. I think Miami also, again, has a really good talent pool. I feel like that was one of the factors that we looked at is New York obviously has probably still the greatest talent pool, right. in the US. But if you look just beyond that, like Miami is actually getting there, especially on the investment and development side. Like you have a lot of very, very skilled people. There's some areas that I would say Miami still has to ramp up. Like, for example, capital formation was very interesting. There's not a lot of like really institutional kind of fundraisers here in Miami. It's more like private wealth focused, but it'll probably get there. You know, it'll just take a few more years. But so we felt good about proximity to Europe, talent pool, and then it was a highly interesting investment market for us. So we were like being on the ground here and really being able to feel the market. That's going to be a very big benefit. And we do think that Miami is probably going to be the market where we have the largest volume of investments and developments. So all of this just made a lot of sense. So I think we were from the beginning very bullish on the city. And look, I feel like 2 years down the road, very happy that this decision was made that way.
I think what's happened here over the last 3 years have been nothing short of a miracle. And what I think is interesting is that even though the macro environment across the world has soured a little bit with interest rates and inflation, the foundation and the seeds that were planted for Miami, talk about Miami in 2027, 2030, it's going to be, I mean, you've got the best view about it, right? You're going to have Mandarin Oriental residence, One Brickell City Center, and you've got all these things that are still coming online. And when you've got these office buildings here, just imagine the worker, the family, the education that's going to come up from that. Education, something that a lot of people focus on in Miami because it's not as strong as it is in the Northeast. And interestingly, I was talking to a developer that builds build-to-suit developments for schools. And he basically mentioned that now his school system across the country is calling him that he wants to be in Miami, that they want to be in Miami. And what he said was super interesting. The land has always been expensive in Miami, and the tuition hasn't been so high. So it just didn't make sense to build schools in Miami.
It's getting there now.
Now tuition is very expensive and getting more expensive. So these schools are like, we need a foothold in Miami.
Yeah, that's good.
So I think, 7 years from now, you're going to have the education, you're going to have the employment base. But it's been incredible to see it here.
It's also like, I feel you probably also travel quite a bit, right? And you do realize, and I don't want to take bad, I'm actually a huge fan of New York, but you do realize like the difference of like how people speak about the current kind of market environment. When you're in New York, obviously there's a lot of exposure to office, right? In New York, and you kind of, either you talk to institutional owners or fundraisers or whoever it might be, but they're in like crisis mode, right? They're trying to solve their problems. They're not even thinking about opportunities. It's really... It's very pronounced.
They're on defense.
They're definitely in defense mode, right? And they have been for like a year or two, I feel like. When you're here in Miami or in Dallas, for example, early this week I was in Dallas for 2 days. Like people have a completely different mindset, right? There's growth happening. The demand side is intact, especially residential. But the good thing is like Miami and Dallas are actually two of the cities you see office development. Like how crazy is that in the current environment, right? And I do feel like that speaks a lot for the market per se. Like if you see offices going up, I mean, again, it tells a story for the demand side, but it also tells a big story for the economy, the local economy, right? About job creation and just economic growth. And so, again, all of that I feel like are very good indications for some of these cities. And
we were just talking about that, right? Think about the people that are building offices, right? You've got Stephen Ross, you've got Ken Griffin, like Swire. It's just like some of the most well-heeled, most known developers in pockets. So it's all the right people. It's the people you want to be sort of building your city and betting on it, right? What Stephen Ross has done in West Palm Beach, he's the largest office owner there over 3 years, has been incredible. So for me, like the ramifications of that are just starting, right? The second order effects are just starting.
Well, and 100% like props to Miami, right? Like to put a framework in place for like national developers, like blue chip names, like related to like make this a focus area nationally, right? To where they say like, hey, look, like circumstances are such that we come in here and we put multiple $100 million projects in office, right, in a city like this. So like also, I feel like all around that's great work by the Miami business community, but also the city, right? Like to, again, put a framework in place where developers have to trust that things are going to keep growing, keep going up.
Yeah, something I remember reading about is like Miami's a young city, right? So the infrastructure is very new. And again, it's forward looking. With someone like New York, you've got hundreds of years of existing infrastructure that you have to work with. And you can notice it in the buildings when you're there. Right? You come to Miami, and you made me realize this actually more than most people when we first met for lunch, where you said, Omar, I look at Miami, even like downtown Miami or like greater downtown Miami area, you know, Brickell to Design District, if you will. And you're like, there's so much land, there's so much opportunity. And I think you drew a parallel with Switzerland, if I'm not mistaken. And I guess like,
I mean, that's the one thing that's still very impressive. I mean, I feel like even today, you know, in Switzerland, it's like, it's a complicated country because it's relatively small. There's just not a lot of land available. It's dense in some places in terms of like not dense because of high rises, but it's just a lot of it is built. So land is just very expensive. Like if you're trying to buy land in Zurich in a good location, I mean, it's just like it's almost the majority of your cost of development is actually tied up in the land. Very similar to New York, right? Where you also kind of got into the 40-50% of a development is land, right? Here in Miami, like we're still looking at, even in the Brickell, which is probably the most dense area, you're still able to buy land. And if you look at the cost component versus like your total development costs, we're probably approaching 15, 20, 25%. If it, but in that area, right, you're kind of moving. And so you kind of have the feeling, if again comparing it to some other dense locations in fast-growing cities, it still seems like even today land is probably still relatively affordable.
Right.
But I know that probably feels completely different from a local perspective because you've lived here for a long time, so you've probably seen land prices just going up and up and up. And so it's probably more the growth rate that throws you off than the actual dollar amount. But it would be interesting to hear kind of your perspective on that.
No, you're 100% right. I was actually in Zurich 2 months ago, and it's like, let's say it's this whole table here. It's just a bunch of 5-story buildings. And I could imagine, I think I saw it was like, a 2-bedroom was 600 square feet for $2 million. And I was like,
that's exactly
oh my God. And then I'm looking at this listing. It's like trying to show you this 2-bedroom and it's like a balcony where you can maybe fit like your shoulder. And I'm just like, this is wild.
That's exactly the way it is. So Switzerland is a pure like renter country basically, right? Like if you're a young person, unless you inherited a significant amount of money, you just can't buy, right? And so people are very used to renting for a very long time. I think part of our thesis actually in the US is that that's kind of what's happening here as well in some places, because if you look at currently, right, like the cost of ownership versus cost of rent, even though rents have gone up very significantly over the last 2 years, but the spread is at an all-time high. Exactly, it's just become very unaffordable for people to own real estate. That's probably a bad thing, but it will also it will cause some people to get creative about it and bring other solutions, right? And it's probably, I feel like one of the solutions is probably some higher quality housing for like that previous, I guess, middle class of the population that was able to buy, that's not now no longer to buy, but that it still has very high kind of criteria and expectations when it comes to their housing situation. So build to rent might be a great solution for this, or some additional Class A property tailored towards these type of demand group. But developers will figure it out, but I think I'm saying this because I feel like the market is shifting in a lot of places over here, and some parallels. Not to say that the market is similar to Europe. There's very clear differences, but there are probably some parallels that can be drawn in a very kind of space-restricted and dense place like Miami.
Yeah, and in South Florida, you've got the Everglades to the west and the ocean to the east. It's landlocked.
People, I mean, I've heard that one when I moved here, was like the Hong Kong of the Caribbean, and it's a very good way to put it, right? There's really no way to go. You're landlocked to both sides.
Right. Yeah. That's so interesting. And I think you're right about the fact that interest rates have gone up. So clearly it hurts asset valuations, but it makes such an impact on the cost of ownership that interest rates going up is actually bullish for rental demand because it just financially makes more. It has never made more financial sense to rent than right now.
100%.
And then you think about that with the cost of ownership going up. I see it in my friends. I grew up in Miami. My friends all thought, myself included, that I was going to have that a $600,000 home was going to be like this great home in the suburbs. And now it's $1.5 million for a townhome, right? It's not even a house. If you want a yard, you're talking 2.5 plus. So two things I'm noticing is I think the percentage of people renting is going to continue increasing long term, which is great for multifamily development and ownership. And then I also think that the cost of the wallet share that people pay for rent in Miami, you know, people would pay 20% of their income in rent. And it was, and like, obviously if you're local, you're complaining, oh, rent is so expensive, but it's like, do you understand that in the West Coast and in other places, people pay 50, 60% of their income in rent. So now if that goes from 20% to 30 or 35 or 40, like it's still healthy relative to the world.
Absolutely. Well, and you also have to realize, I think, how incomes have risen here in Miami over the last few years as well, right? Like with all these jobs and firms coming in, like there's a lot of firms that pay salaries that are significantly higher than probably previously in Miami. And I feel like you see that, right? When you look into the different rental properties here and you get some information about the tenant profile of the tenants that live there. Those are all pretty high earners. So, and across the spectrum, not to say that you obviously also need some more affordable living space.
For sure.
But you still, I think it does show that there's plenty of people that are able to afford these type of rents, right? Like when you look at the percentage of income to rent that they're paying at these elevated rents.
I could tell you my building, I live in Brickell, my building completely changed demographic profile in 2 to 3 years. From 2020 to 2023 today, I used to have nothing but Colombian, Venezuelan, South American people that were either, I don't want to say in school, but like not really employed. They were like entrepreneurs, but their parents had money and that's how they sort of lived here. Now my building, all of them, I'm telling you, all of them are like Northeast, West Coast, like engineers, like finance guys and you know, tech people. And it's people making 150, 250 plus $1,000. And I'm like, oh my God, my building went from speaking Spanish to speaking English. It's crazy.
It is crazy. It is, you know, and at the same time, like when you look at, I mean, we're Class A developers, right? Multifamily. So we look in a market like Brickell and you look at the total unit count of like true Class A properties that you would say, okay, this type of unit would be attractive to a person like the one that you just described. There's really not a lot of buildings that fit into that profile. You know, we maybe have 4 properties that truly, from a quality perspective, fit there. And if you add up all the kind of the total units, you're maybe approaching, I don't know, 1,500 units or so.
This is like Solitaire, or like Bezel.
Exactly. Solitaire, Bezel, maybe Muse, Maison, if you also want to count in there. I think Panorama Tower is already a very different product type because it's huge units. But so the total unit count of just those, it's very low for, you know, an urban area like Brickell has become. That's just, again, a very large local economy. And so even though there is a lot of development coming in, Miami probably needs this development, right? Like there's definitely more units.
The highest end Class A rentals. And I actually, there's multiple groups that have that thesis in mind because they're like, I realize that people making $250,000 all live in condos. They don't own the condos, they're renting the condos. So I could see you guys putting condo quality work into a city. And again, to your point, being one of 5 buildings, one of 6 buildings. And you mentioned something interesting that I want to touch on. I've been in Miami for a long time. And I actually think you guys, having the global perspective that you guys have, are able to see Miami in a different lens than local developers that I've done business with for 10 years. And what's interesting is that it's the local developers that have been here for a very long time, they see the prices that land is trading at right now, and they just can't believe it because they remember that 5 years ago, that land was worth a quarter of that. And 7 years ago, it was worth, you know, less than a quarter of that. So now they're like, no, there's no way anybody's going to pay that. That's crazy prices. And then people like you come in and you're like, the math makes sense. We're believing the market long term. And you come at it with fresh eyes. So it's interesting. We sold an acre in downtown Miami to a developer out of Chicago, right? John Buck Company. And it's, again, speaking to the quality of the developer coming in here. I didn't know who John Buck Company was. I put that on Twitter. Like, you know, I made a joke of like, I sold it to John Buck Company who I didn't know who they was. And people like attacked me. They're like, how do you not know who John Buck Company is? They're multi-billion-dollar developers. I'm like, I just don't know them. So they beat out all the local bidders because they have a different lens.
I mean, of course,
into
also,
the market.
Yeah, exactly. I mean, if you're used to Chicago or New York development and see not only the prices, right, it's also the ease of development that's completely different in Miami. Like here, the city is actually supportive of additional supply. Like they want that to happen. So I think for a lot of developers from out of town, like with some of the issues that you're having maybe in their local markets, this looks great. Yeah. And yeah, I feel like, I feel like it all comes back to the demand side, right? Like where a lot of people feel good about. And that's why, like, so for our 2 Miami projects, I mean, we're scheduled to break ground next year.
Yeah, let's talk about these.
Yeah. Yeah, so it's basically 2 projects, right? Scheduled to break ground next year. So one is a 85-unit project in the Rhodes neighborhood, so Coral Way, just outside of Brickell. The other one is really a high-rise 310-unit project in Brickell. And very similar timelines, right? Like, so they were delivering either like the smaller one late 25 and the larger one in about mid 26. What we actually believe is going to be a very, very good time to deliver new properties, because what you see right now, obviously, again, due to interest rates and the topics we talked about, there's not a lot of developments that get started these days. At the same time, demand hasn't really like flattened, right? Like there's still a lot of demand. So while you will probably see, and that's kind of our thesis, is over the course of the next years, there are some units being delivered, right? And there's definitely
just 1 or 2.
Yeah, there's a few coming in. So you have a bit of a spike. I'm sure that a lot of these managers still be competing in terms of lease up.
Concessions,
exactly.
Just try to fill up as quickly as possible.
It'll probably go slower, right? Like, because you had amazingly fast lease up speeds like over the last 1 or 2 years.
Oh my God.
That has to extend.
plus units a month.
Exactly. I mean, that has to, there's probably, I mean, the heat will come out of this a little bit. And some of these properties that are getting delivered in 24, they're probably going to see larger lease ups and higher vacancy for a longer time. But at the same time, like, the demand will probably stay strong. And so for developers that are able to make things happen and put shovels into the ground and deliver in maybe 25, 26, 27, when not a lot of other people's are, and when we're probably through this maybe prolonged time of lease up, you probably have a very fertile ground then what deliver. Like, yeah, when it comes to leasing up these assets, and then probably also really rent growth, right, due to the lack of supply. And so that whole part of it also makes us feel good now. Not to say there's no challenges, right? I mean, especially the debt side is challenging. There's just not a lot of construction lenders out there right now that are willing to finance projects. So that's definitely the major part to kind of navigate. But I feel like, again, like, given how healthy the demand side of the equation is, if you're able to kind of figure out the financing part and get your capital stack together, then it should be a good environment.
And to your point, when it was easy to get construction loans, raise capital, for example, I think like 2021 was probably peak capital raising environment. So many shovels went into the ground. You fast forward 3 years, we're coming into 2024, where there's 17,500 units coming online in Miami. And to your point, we'll see sort of pressure on the rental side of the equation. But people are like, our rent's down. And I'm like, it depends on your point of reference. Our rent's down from 18 months ago when everybody was coming into Miami. And again, it just takes time to build a building. Right? So I think it'll normalize in a healthy way. But it'll still, all those people coming in here is still going to continue trending upwards.
100%.
And to your point, you're putting a shovel on the ground, 2 shovels in the ground when nobody else is, or very few people are. So come 2027, 2028, I'm assuming when you're delivering this product, you're going to be the only game in town.
Right. That's, I mean, look, that's kind of the thesis. I think there's some other things that may happen, hopefully play in our favor, but we're in an interesting time right now where we're negotiating with a lot of, not only GC, but really subcontractors about obviously the trade agreements, right, for the construction. And the one thing that you realize when you have these conversations is right now everybody's super busy, right, because of all the development going on. They're already starting to think about kind of 12, 18 months ahead, and they see their own pipeline kind of dwindling. So they're definitely more in business development mode than they were 6 to 12 months ago. But at the same time, like, and this is where it becomes interesting, they still see, when you have these one-on-ones with them, they still see some projects that they think that they're going to come their way, but we already know they're not, because we've been offered, like, we've literally had them on the table, like, that they're being sold, that their developers not executing. So I feel like that entire information funnel that hasn't really flowed through yet, right? And so I think when all of this happens and it becomes clear, okay, like, there's a lot of things that are just not going to happen, you're probably also going to see construction costs come down quite a bit, right? And again, for a developer that can line it up and not, it's difficult to time that, but it does seem like that's a possibility that could also be in your favor. Then it will obviously make the project even look better.
Yeah, I think if you think about risk-adjusted return, right? It's like right now, not that many people are bidding on sites.
Yeah.
Right.
Yeah.
Clearly, capital market environment is a challenge. But if you could either over-equitize, you've got a fund, so you can massage that a little better than most.
Yeah.
But then also costs are probably not going to get higher.
Yeah.
Right.
Yeah.
And then rents may soften in the next 6 to 18 months, but we're delivering in 24 to 36 months. So you just get those variables, and you're like, hey, there's a lot of good things that we could see in the future by taking the step forward today.
Yeah, right.
I was laughing at the GC comment. I've been talking to GCs recently, and they're, I've got 7 projects in the pipeline. And
they're oblivious.
They walk me through the pipeline, and I'm like, this guy is trying to sell the building. This guy's not going to break ground. And I'm like, you've got 2 projects in the pipeline.
It's really, that's one of the more interesting things. And I feel like I know.
I've had the people in front of me trying to work with us. Like,
it's exactly that. It's exactly that. And it's one of the more interesting things. I think you can kind of know why that's happening, because over the last, maybe 2 years or so, it was so difficult to get actually workers in, right? Because there's so much work that you actually had to worry about not finding kind of the right firm for your project. And so I feel like right now we're in an environment where the last person that you're telling that you're not moving forward is actually the GC and then the trades behind it. Because you don't want to fall off their books, right? Like you kind of want to stay on there for as long as possible. But again, they're not necessarily aware of that, which I feel like makes some of the price adjustment, it drags it out.
Yeah,
it will happen, but it lags. Yeah.
That's exactly right. So you, correct me if I'm wrong, you lived in Zurich, you lived in Madrid.
Yeah, I did. Yeah, for a year. And then I studied and lived in Dallas, actually. So
Dallas, and now you're in Miami.
Yeah.
Talk to me how you every place is different and has its strengths, but how do you see Miami? Because I only ever known Miami.
Yeah.
I've visited places, but when you're doing 4 days in Paris or 4 days in Zurich, you don't really know.
Yeah.
You know?
Yeah.
How has it been for you? What do you know? How are you liking it?
It's super interesting. I mean, I think, so I have actually, I have family in Ecuador, right? So my wife's Ecuadorian, so spend a lot of time there. And it's one of the things that I feel like are very interesting about Miami is you see a lot of similarities in terms of behavior and how things are done to some large cities in South America, let's say, or Latin America, right? But I think what it does actually, and this is where Miami becomes highly interesting to me, is you have all the infrastructure and kind of the business power of a kind of large US city, but you actually get also a lot of the entrepreneurship and maybe some of the bad things that come with that as well, but of some of these maybe Latin American or South American countries. And I feel like it kind of makes it a very, very dynamic mix, much more so than any other city that I've been. And I've loved pretty much all the different places that I've lived in. But Miami is special. Miami definitely kind of is outside of the other few, where everything else is a lot more. It's just much more even keel, right? Everything is slower and less dynamic, whereas in Miami, things are really, really moving. Yeah. And it's probably also at the time in the market right now where things are moving fast and where a lot of people are moving in, bringing new ideas. But I do feel like that's definitely something that differentiates Miami quite a bit,
Yeah, something that's changed dramatically over the last 36 months is in Miami, now you have sort of New York type opportunities. Yeah. You can personally run as fast as you professionally want to. Right. But I think Miami also allows you to want to go to the beach, want to go on a cruise, or if you want to party till 5 in the morning, you want to have that one night and do whatever you want. Yeah. It's sometimes some of the complaints that I hear, it's there's too many distractions in Miami. Yeah. And I'm I'm not going to disagree with that, right? But that's a willpower and discipline thing, right?
Yeah, it is 100%. But to me, honestly, moving into the city, that was actually one of the key challenges. And granted, I came from Switzerland, which is just due to size, right? There's not as much going on as here. It's also, Switzerland is also a very dynamic and the economy is performing extremely well, but Zurich just has a different size compared to Miami, right? And so I think here you move in and you have there's something every single day. If you want to, it doesn't stop. The city doesn't stop, right? And so you have to really be disciplined with yourself to kind of say, okay, which are the things that are really, really important that you expose yourself to? Yeah. And what are some other things where you kind of have to find a balance, also for your private life, right? And so,
It's interesting for me when people move here or when they think about moving here, initially they'll think, I can't live in Miami because they're thinking Vegas and they're thinking this crazy weekend. And I'm talk to me about the last time you visited Miami. And they're we flew in, we got on the yacht, Then we went to 11, and I'm like, okay, that's not Miami.
It's not Miami. Well, the thing is also it happens to me a ton actually, where to a lot of people, or like people like Europeans in this case, like I think a lot of people think of Miami as Miami Beach.
Yeah.
And that's a mistake, right? Like Miami Beach and Miami, those are two different things. Like both are great for its own reason, yeah, but they're very, very different. And so I think a lot of, like now obviously living here, I have the benefit of like having the ability to show people around. And I do realize over and over again how impressed they are by seeing Brickell or like seeing Wynwood or seeing Coral Gables, and kind of getting that whole diversity. Like Miami is a very diverse city, right? Like every part of town feels a little bit different, have different people, there's different exposures. So unless, I mean, if Miami Beach is the only thing you know, you're really missing out a lot of it.
Correct. Yeah. And I think what's interesting about, so McKinsey put out like a presentation with a lot of great information. And part of the things that they mentioned was like, Miami has the most entrepreneurs per capita, I think it was, than any city in the US. Because I think what happened here historically is you have a very entrepreneurial mindset from the international countries, A, and then B, since there wasn't these jobs that get you paid $200,000-300,000 a year, you would have your $80,000 salary, but then you were also trying to figure entrepreneurial things out. What I find most interesting about that is, I think the direction in which work is headed and the economy is headed is going to favor entrepreneurialism. If you think about work 40 years ago, people were lifers. I go to a company and I'm there for 40 years and that's my life, my pension and everything. Slowly but surely, and now actually even more exponentially it's growing, people are making money by being entrepreneurs. And if you think about like AI and machine learning and how that allows people to leverage themselves and their capabilities to make money online, it favors the entrepreneur. So I think it's a dynamic that I've been thinking about recently where I'm like, I think Miami and the people here, the creative spirit, the optimism is going to actually be a boon to real estate prices, rental prices, long term, because they're thinking so ahead.
Yeah, I fully agree with you. I mean, look, it's my hope as well. Hopefully, like, we manage to turn like whatever advancements AI gives us into enhancing our productivity so that we have even more time to do other things, right? Besides our kind of day-to-day jobs. And I feel like Miami, again, like being one of the cities that where you do see people are very, very active, right? Like, I mean, most people you meet, they have their day job, but they have multiple other initiatives that they're pursuing. So I agree with you. Like, I feel like it will be a city that will hopefully benefit from that a lot. And then I think in Miami too, you've got people that they enjoy the sun, they want to be outside, they live a healthier lifestyle. I want to say for sure.
And for you, big golfer. So did you play golf? I guess I want to end on a personal note. You played golf in Switzerland, like growing up, or how'd you get into that? Because you're not a casual golfer. No, not a casual golfer. No, I mean, I pretty much was fortunate to like grow up right next to a golf course. So I started golfing very, very early on. Then like took it very serious from like, I think when I maybe turned 13, 14, that's when I started taking it more serious and seriously. And I mean, it gave me the opportunity. So I actually came from a really small village, right? Like my village had like population of 2,000 people. So 2,000? Yeah,
one
building.
Yeah, exactly. That's one building in Miami. I mean, very rural place as well, right? Like, and so countryside in Switzerland. Kind of great place to grow up. Like had a lot of like good benefits, right? And like middle of nature and, but I feel like golf kind of gave me the opportunity as I got better in it to kind of compete internationally and see different places. So for example, like we used to spend winters when it was too cold in Switzerland. We used to go to Dubai, train there, play tournaments there, which was incredible, right? Like for a 15, 16-year-old guy to be able to do that, especially kind of coming from a small place like this. So it was great to actually like, it opened a lot of doors. It was essentially then really also the reason why I ended up in the US. So graduated high school and then actually came to the US to actually play tournaments over here, which I ended up joining SMU in Dallas. Played college golf, it was at SMU, a fantastic time. I mean, time of my life, really. I was able to play college golf there again, like got my degree, and then that's kind of how I actually got into the US. And so from what initially was like the idea of playing a few tournaments and then maybe go back to Switzerland, ended up like spending several years here and now making it a permanent home.
That is amazing. And I'll actually add a comment to one of his coworkers, Bronco, Kuzmanovic, I believe is his last name.
He's a really, really good tennis player.
Yeah, he was, I believe, like #2 in Serbia, but pretty much like played tennis against Djokovic at one point of his career. So you've got a scratch golfer and like a pro tennis player. I'm like, they're not messing around.
It honestly, it wasn't planned that way, but the good thing is like it. I think it does a few things to you, right? Like when you have to dedicate yourself so much, and I see it with Bronco as well, right? Like you do have to, you need to be a little bit disciplined. Like you have to be a kind of a good team. Team player, because like whatever sport you do, even if it's an individual sport, like you're always going to be working with either trainers or team or like other golfers when you kind of compete in a team event. And I see the same thing in Bronco, so that's why it's a good mix.
It's a great quality to have.
Yeah, that's a good team atmosphere. Yeah.
Rafael, how can people reach out to you, get in touch if they want to have any more dialogue with you?
Yeah, I mean, we're here in Miami now again. Like opened the office a couple months ago. So like come here, see us. Like love to host everybody that's obviously interested in meeting us and working with us. And so we're open for business. Hopefully we can do business in Miami for a very long time and other cities across the Sunbelt as well. So definitely love to get in touch with additional people here that are active in the Sunbelt. Yeah.
Thank you so much for the time. I can't wait to continue selling you real estate and seeing you build ultra luxury Class A rental apartments.
Absolutely. No, thanks a lot for the time and enjoyed it a lot.
Thank you.
Cheers.